Well, a warm welcome to everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial, which is a locally owned and locally staffed financial planning firm here in Brisbane. Today we have Charles Hamieh from Clearbridge Investments. Charles co-manages all global infrastructure strategies. He has 27 years of investment industry experience. Previously, he was a director, senior analyst of global infrastructure securities at AMP Capital, as well as a director of infrastructure securities at Hastings Fund Management. He was also head of listed infrastructure at Challenger Financial Services Group, a portfolio manager at AMP Capital Investors, an analyst and strategist at HSBC Australia. But before we get stuck into our discussion, I would like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Also, please refer to any product disclosure statement regarding the financial products for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website. Thanks for joining me today, Charles. As an investment manager specialising in infrastructure, can you talk us through Clearbridge's value strategy history and investment philosophy?
Thanks, Joel, not a problem. And thanks to everyone from the Solace Network for your continued support and for dialing in or jumping on today. So key to our philosophy has always been to take almost a long-dated private markets approach to assessing infrastructure assets and to executing those views in the listed market. So to focus on the underlying assets, to focus on the cash generation from those assets, the regulatory dynamics, where long-term our approach is absolute return. But we always aim to use liquidity to exploit those mispricings we see in underlying assets. And that's primarily driven by the short-term focus of others. So to do that, our team are infrastructure specialists first and foremost. We've experienced across a diverse range of infrastructure backgrounds, and my background is direct infrastructure prior to joining Clearbridge almost 15 years ago. And key to that approach is collaboration, peer review, challenge. All of us sitting in one office with portfolio managers sitting and working alongside analysts, guiding and testing the assumptions, all designed to enhance issue discovery. And that's sort of been a real hallmark of our process since day one. And that's resulted in a really unique risk return profile, one where the strategy delivers really strong downside protection in falling markets, but really good upside capture, in rising markets. So that's sort of the process in a nutshell.
Okay. So how do you assess risk when you make the investment decisions?
So risk for us is really almost a multi-layered approach. Our approach to risk management is multi-layered, and it starts from everything from our proprietary universe to having consistent, macroeconomic data, the inputs, consistent quantitative and qualitative frameworks, a portfolio or a team-based approach to decision making. We have a large team, so our fundamental analysis is very robust. We have obviously having a large team allows us to have more models in more detail on more companies. It allows us to spend more time understanding the long-term drivers of cash flow and dividends, to model different valuation scenarios, so basically to get a really solid understanding of that risk profile. We sort of focus on the fundamental risk in our required return or our hurdle rate. Then we add sort of layers of risk, taking into account liquidity, ESG risk, etc. And then at the end of that, we utilize risk management tools. We have a quarterly review meeting of those risks, those various risks in the team. So ultimately, Joel, it's an approach where we're seeking to maximize total return whilst mitigating the downside risks. And that's sort of always front and center in everything we do, thinking about risk and return in the same equation.
Sure. So what are the opportunities and risks that you see in the marketplace at the moment?
Let's focus on opportunities first. And obviously, if we think about the asset class, we think there's three key thematics or structural drivers that are really sort of providing a really strong undercurrent, which is pushing the sector forward. The first one is decarbonisation and net zero. So, the transition towards net zero, the asset class is right at the forefront of delivering on that. And that's pretty important. And that's been a more of a medium-term theme. More recently, we've seen the need for really significant network infrastructure. So connecting and strengthening of networks to facilitate decarbonisation, to replace aging infrastructure. More recently, the onshoring, which we're seeing globally, and the realignment of supply chains. And the last 6 months or so, obviously, the energy requirement to facilitate, the data centers and AI data centers in particular. And that's sort of a really important thematic. But ultimately, all those three are driving what we think is a long-term opportunity. Now, I think quite often when people talk about opportunities, it's good to sort of bring it down to its lowest form. And let me give you sort of an example of just the amount of energy required to drive the data center thematic. So if you think about Facebook or Meta, they trained Llama 3, their language model, using 16,000 NVIDIA H100 chips. And each one of these H100 chips, which is a current generation of chips, are around 700 watts. And running those at 90% utilization has the same power draw as 1.5 households. The new B100 chips are 1,000 watts, and they have 50% more power, 50% more power draw, sorry, but are 5 times faster. But putting that aside, so Llama 3 was trained using 16,000 one of these H100 chips, so around equivalent to the same power draw as a town of 50 to 60,000 people. Their Llama 4 model is being trained on 160,000 of these H100 chips, so equivalent to the power draw of a city of 500,000 people. So a huge amount of power required just to facilitate that energy transition. And that's touching almost every part of our universe. So we see enormous opportunities from utilities through to energy infrastructure, all the way down to toll roads and airports, etc. Now, the risks are also, interesting. Obviously, for us, the most important risks are, the stock-specific risks. So at a company level, closely focused on asset-based growth, operational performance, regulatory outcomes. As it relates to those risks, we're very comfortable. The consistent theme across all the companies the strategy invests in is just how strong their asset-based growth is. And that's not the ultimate driver of all the portfolio outcomes. But more generally, like all asset managers, the more tactical risks around inflation, interest rates, growth, and now obviously the narrative and how that's all impacted by the election of Trump is also important to us. And in particular, the Inflation Reduction Act, which was a Biden administration policy, Trump on the campaign trail, made note that he was going to repeal or sunset early various components of that. Now, we think that's very unlikely, and unlikely for two reasons. One is that policy has created tens of thousands of jobs, manufacturing jobs in particular, and primarily in Republican states, disproportionately in Republican states compared to Democratic states. I think the number is 3-to-1 direct jobs and 5-to-1 indirect jobs. Secondly, probably more importantly, that policy has really reduced US reliance on China. So we just find it very difficult to believe that a new administration, a Republican administration, will intentionally repeal or sunset early a policy which has really benefited Republican states in particular. So even with that risk, we're pretty comfortable at the moment.
Okay. So what is Clearbridge's greatest strength as a value strategy manager?
Well, I think we're, Joel, pioneers in the asset class, first and foremost. We've been managing listed infrastructure money now since 2006. And it really is a function of our unique process and how we think about risk and return in portfolio construction. But if there was 4 critical areas which I think sort of really differentiate us, the first would be having our proprietary universe. So being benchmark unaware means that the starting point is very important. And so from day one, we've had our own universe. Secondly, that focus on both risk and return, and I touched upon that a bit earlier. Thirdly, the integration of ESG both into our cash flows and our hurdle rate. which has been a key part of our process again, almost since day one. And finally, being benchmark unaware. There's no point having the best process, the best team, if at the end of the day you're at the mercy of a benchmark. So what we try to do consistently is, in portfolio construction in particular, is balance the duration of the catalysts with the duration of risks. So understanding a company's overall risk, potential upside and downside scenario, and then determining the appropriate portfolio weight without reference to a benchmark. And I made the point earlier, what it's allowed us to do is deliver these really differentiated portfolios.
Okay. Can you talk us through a time when you've turned a period of poor performance or poor returns into an investment opportunity and turned the performance around?
That's a really good question, Joel, because quite often when you see periods of challenge returns for the asset class, um, it's not a function of a stock issue or a sector issue. It really is a function of just the market narrative dictating how the asset class performs. And that's sort of what happened at the beginning of this year. I'll give you a recent example. You had the macro headwind. You had, obviously with rising rates and stubborn inflation, and that sort of really challenged the sector narrative to some extent. But we use that weakness to reposition the portfolio. So to go out and speak to clients and say, hey, we are very certain that this is just noise. The companies are doing extraordinarily well, but we're using this weakness we're seeing to think more closely about how we want the portfolio to be positioned on a 1 year view. So from the beginning of the year, we've been selectively reducing our exposure to Europe, increasing our exposure to North American utilities, where we are confident the market is massively underestimating the growth in electricity demand, driven by what I said earlier, AI and data growth, amongst other things, and also increasing our exposure to selected user pays assets, in particular North American rail. And so the market gave us that opportunity because of really tempered performance to build the portfolio accordingly. And we've seen the benefit of that now in the last 3 to 6 months. You've had a significant re-rating of those US utilities and some of our bigger positions in particular, a significant re-rating in the North American energy infrastructure complex. And we're starting to see the inflection of some of the user pays assets, some of those assets in Europe, the airports in particular, and some of the North American rail assets. So using that tempered performance to reposition and look a year out.
Okay. Charles, how do you stay up to date with the changes in financial markets?
Obviously, made the point earlier, we have one of the largest teams in the market. And so the analysts have access to everyone. They speak to companies more often, which is important. We have access to all the various, data tools that people would be aware of, Reuters, Bloomberg, etc., to provide information. But most importantly, we have access to the companies. We're a long-only manager. We're patient capital. So our access to CEOs and CFOs in particular globally is second to none. And that's pretty important and probably the main source of our information. We also have a global trading desk, and that desk is based in New York and Sydney. And that allows us to get all the trading color, which more recently is becoming a bit more important. It doesn't dictate the medium to long-term position sizing, but certainly allows us to sort of get ahead of that short-term noise and focus on those long-term drivers of cash flow. So it's been, getting that information, especially now, is pretty important. But again, being long-term investors and being patient capital, the source of that information, the best source of that information, typically speaks to the companies directly.
So, Charles, what does make a good portfolio manager overall?
What makes a good portfolio manager? Well, I think that's probably a pretty individual question. If I think about my 25 years experience plus of managing money and speaking to portfolio managers all over the world, I think there's some common traits in a good portfolio manager. I think firstly, almost all of them have a pretty deep financial knowledge. They understand how to analyze financial statements. They understand macroeconomic data, the interaction between a balance sheet and a cash flow and a P&L. I think they all think strategically and they understand risk, which is pretty important. And they're very effective communicators. I mean, that's very important when dealing with internal stakeholders, but also dealing with external stakeholders. But most importantly, I think, and I think it really resonates with what we do, they're very disciplined in decision making. So staying rational under pressure, avoiding those emotional or impulsive trades, and just adhering to a consistent investment philosophy and process. And it's much easier said than done, Joel. But certainly, it's something we've been able to do for the last almost 20 years. And a lot of the global fund managers that I really respect have also been able to do that very, very well.
Okay. So Charles, we've covered a lot of ground this afternoon. Is there anything that you'd like to add that we haven't already discussed?
Well, I think importantly, instead of sort of adding something different, just to focus on some of those points I made earlier. Obviously, the sector has done very, very well. Strategy's done very, very well in the last year, but we really think we're right at the beginning of long-term generational capex. And that's going to really drive the asset-based growth of many of these companies that we invest in. And it's about asset-based growth, the link between asset-based growth, allowed returns, and nominal return on equities, which ultimately drives the really attractive outcomes that we've seen and we will see going forward. And as I said, I think we're right at the beginning of that. Companies we speak to and we've been speaking to for a very long time, are probably as excited as they've ever been about the opportunity going forward. And that sort of certainly makes us excited as investors as well.
Okay. Well, Charles, I appreciate you making the time to talk with us today. Um,
Thank you very
Thanks
much,
again,
mate.
and we'd love to have you get back in the future at some stage.
Always happy to be back, mate, and always happy to speak to investors. And again, thanks so much to the Solace Network for your continued support.
Appreciate it. If you'd like to talk to Solace Financial regarding your current financial strategy and if it's suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment. Thanks again for your time, Charles. I really enjoyed the conversation and found your insights really, really interesting.